Hey everybody, it's the Investments Lawyer, and today we're going to talk about the difference between multi-asset funds and single-asset SPVs or syndications. And remember, nothing we talk about here is legal advice, so for that, find an attorney. Okay, let's dive in. So today, like I said, we're talking about the difference between vehicles with multiple assets. So for example, a real estate fund that invests in a bunch of different houses or apartment buildings, and a single asset SPV or syndication. So you're buying just one apartment building. Another example could be a multi-asset fund is a venture capital fund or a private equity fund, and a single asset SPV would just be investing in one company or even the securities of one company. So like, Series B stock in a company. So other than the fact that one has multiple assets and one only has one asset, what are the differences? Let's talk about them right now. So in a multi-asset fund, you raise money just once for each fund. So you go out and fundraise and say, we're going to raise a fund. You want to join? In contrast, in a single asset SPV or syndication, you raise money each time you have a new deal because each SPV just has one deal. So for example, if you have a real estate fund, you'll just raise that real estate fund once. You might raise another fund later, but for that fund, you might do 5, 10 deals in just one fund. You're fundraising once. On the other hand, if you do things deal by deal, as it's called, and you form a single asset SPV or syndication, those are kind of interchangeable words for each one, then you're going to have to raise money time and time again. So it's a little bit more annoying if you're the GP to do it the syndication way because you have to keep raising money as opposed to a fund. Next, it's sometimes harder to raise capital for a multi-asset fund because the investors don't know what the actual investments are. On the other hand, it's often easier to raise an SPV or a syndication because the PPM and the deck will talk about the specific deal, and so investors will get a flavor of what they're investing in, and they might be more likely to invest. Not all the time, though. Okay, in a multi-asset fund, you call capital over time. So an LP will commit up front, and then the fund will draw down that capital over time in what's called the fund's investment period. In an SPV or syndication, you might call all the capital right up front at once. It's possible you might call capital over time, but often you call the capital all at once. All right, let's move on. Fast deployment. So in a fund, you have committed capital. So if you find a good deal, you can just say, hey, LPs, send me the money in 5 days. Let's do this deal. It's very easy, low friction for the GP. On the other hand, for an SPV, if you find a deal, then you're going to have to spin up an SPV or a syndication vehicle to go acquire that property. So it can take longer. It's a bit more of a hassle. Moving on, in a fund, you often have a netted waterfall, which means LPs have to get their money back that they contributed for all the deals in the fund before the GP gets a profit split or promote or carried interest. Those are all the same thing. On the other hand, if you're going deal by deal, the waterfall isn't netted between different deals because there's only one deal in each SPV. So this is a little bit better for the GPs because if they have, 2 bad deals and 2 good deals, the bad deals, whatever, but they'll get paid on the 2 good deals. Whereas maybe in a netted waterfall, they wouldn't actually get paid because the LPs would have to get paid back for the money that they contributed to all 4 deals. Whereas in deal by deal, it's not netted, it's separate. All right, and finally, how much does it cost? So it's usually more expensive to form a fund than an SPV, just because a fund is a more complex legal document. You might need more service providers. The SPVs are a bit simpler. Now, that being said, there's a caveat. Because remember, if you're buying 5 or 10 deals, you're going to need 5 or 10 syndication vehicles. And if you were just going to form one fund, then you would only need to form it once. So, it'll be some cost-benefit analysis on your part to see what is cheaper for you. So one fund is almost always cheaper than 5 or 10 syndications, but you'd have to figure that out on your own. All right, cool. Well, thank you for sticking with me in this video. Would love it if you would subscribe down in the bottom right if you like what you're seeing, and would love if you would share with your friends. All right, cool. We'll see you at the next video. Thanks.